Right, for grade 11s and grade 12s, a very important concept that you have to do under cost accounting is that of being able to calculate and comment on the break-even point. Now, the break-even point means that your scales are basically in balance, that you're getting enough income in to pay out all your expenses. At the break-even point, you won't be making any profit, but at least all your expenses are actually being covered. Now, when we talk about expenses, we've actually got two types of expenses or costs that are in a manufacturing concern. And the first one is the fixed costs. And these stay the same over a period of time. Please take notes, not forever, but over a period of time, irrespective of the amount of goods that are produced. So whether you produce one item, 100 items, or 1,000 items, certain items will stay exactly the same. For example, the rent of the plant or the factory. Generally, rents increase once a year, so that's where the period of time comes. But whether there's any production going on or not at that particular point in time, the rent will stay the same. The manager or foreman's salary is also generally not dependent on the number of goods. Interest on loan has got nothing to do with the goods, it depends on the value of the loan. Whereas variable costs, as the word says, they vary. They vary in direct proportion to the amount of goods produced. And that here we're looking at our raw materials or our direct materials, our direct labor, our commission, which would be given to the salesman, our distribution costs, which is our delivery expenses. Now what we're saying here is that if I was to produce more items, these items would increase. If it costs me 10 Rand to make a t-shirt in terms of raw material, 2 t-shirts are going to cost me 20 Rand, 3 t-shirts are going to cost me 30 Rand. So these two costs are very important when we come to work out our break even, because the variable costs are going to keep increasing. As you increase production, so they will increase. But your fixed costs will be staying the same, and you need to make enough money to pay the variable costs plus your fixed costs. So let's just take a simple example as I use the t-shirts. Now let's say I'm making t-shirts and I sell each t-shirt for 25 Rand. So the selling price is exactly the same. My variable cost, now the variable cost would be the material, the labor, the commission, and the delivery costs of those things, comes to 15 Rand. So therefore, out of that t-shirt, after I've paid the variable costs, I've got 10 Rand left over. I make a second t-shirt, sell it also for 25 Rand. It also, in terms of variable costs, and please take note, I'm stressing variable costs here, is 15 Rand, and there's another 10 Rand. And so it'll go on with every one of the t-shirts you make. And that's where, remember I said to you, the variable cost will vary in direct proportion to the number of goods. Every t-shirt will have its own variable cost of 15 Rand. But out of every t-shirt, there's a surplus of 10 Rand. Now that 10 Rand is going to go into like a big pot. And that's going to be used to cover your fixed costs, because we haven't taken fixed costs into here. This is just the making side of it, and then the selling side of it. We then have to cover all our fixed costs. And so out of this bag over here, out of all these 10 Rands we're making here, we need to say, well, how many t-shirts am I going to have to make in order to cover those fixed costs? And if we take an example that I have my fixed cost, which is my rent, my factory, all my factory overheads, and my admin costs. That the fixed costs are basically your factory overheads and your admin costs. That comes to 50,000. Now that will stay the same over a period of time. If every t-shirt is contributing 10 Rand towards this, I am going to have to make 5,000 t-shirts in order to cover that 50,000. And so at 5,000 t-shirts, I will have paid for all the variable costs, all the material and labor made to that. I will have a surplus, and that surplus, that 10 Rand, will be enough to cover my fixed costs. And so at that point in time, you will be breaking even. So your break-even point is 5,000 t-shirts. You have to make and sell, because remember, it's not just making them, you've got to sell them as well. You've got to make and sell 5,000 t-shirts before you can incur profit. And that brings us into the formula which we use, which is exactly what I've just said there, is my fixed cost, which is made up of, and we do simplify it a bit at school. It's not exactly 100% correct, but for your studies, all your factory overheads and all your admin costs will make up your fixed costs. Don't try and decipher some of this and say, well, those are not a fixed cost. At school level, we just accept it that that's what it is. And then the selling price minus the variable cost gives us our contribution. Go back there. Our selling price of 25 Rand minus our variable cost gives us a 10 Rand. That 10 Rand there is the contribution. It's what's left over. And every t-shirt will bring in the 10 Rand. So we take the selling price minus the variable cost, which is then 10 Rand, and we divide it in, which is exactly what we've just got here. So that's the formula for break even. Right, now I'm going to look at an example, and it is actually the exemplar paper that New Era has put out for the year 2020's matrics. But grade 11s, you can follow it as well because it's also relevant to you. This paper is available on the web if you'd like to have a look for it, if your teachers haven't yet given it to you. And so we've got a manufacturing business here which is making biscuits and it's making cereal. So we've got a whole lot of information to do with the biscuits and the cereal. Just let's have a look at the information first of all. And I'm going to look at just the biscuits at the moment because it's the same thing and I don't want to repeat a whole lot of figures. The units produced and sold, and please take note, that's very important. We've got to be able to sell these units before we can start making a profit. And that's in April and that is in March. Your total cost of production, your unit cost, which is just dividing by the number of units, the selling price per unit, what you're selling it for, what your markup is, and there's your break-even point. We're given last month, but we're not given this month. We're then given our unit costs, and as I said to you in the example I've just looked at, your variable costs is made up of your direct material, your direct labor, and your selling and distribution. In other words, 56 Rand 50 is your variable cost. Your fixed costs is your factory overheads and your admin costs. And there's your cost per unit, or 29 Rand 70. And then we've got some further information over here from the income statement, our sales figure, our gross profit, and then our final net loss. And here's our total costs, our total variable costs, and our total fixed costs. Right, so now that's the information, and I will keep referring to it in case you don't have the sheet in front of you. Now I'm not going to do all of these questions, but I'm just highlighting a few. Just first of all, they do ask you what the total cost of production is in the production cost statement. They did not ask you to draw up a production cost statement, but we've just done it in our lessons. And remember, our production cost statement is made up of our material, our labor, and our factory overheads. And if there was some work in progress, we'd have to take that into account. But I can tell you now, learners, that whenever you get into this unit cost, there will always be there is no work in progress at the beginning or end. And so our total cost of production is just your material cost, your labor cost, and your factory overheads. Cost times by the number of units that you've produced. That'll be your cost of production. Just a shorter way instead of drawing up a whole production cost statement. And then what we're focusing on is to work out the break-even point. So let's look at what information we need. Remember the formula that we just said over here is we need to know our total fixed costs. Our total fixed costs that we need. We need to know the selling price minus the variable cost per unit. So just looking at the sheet over here now, please, can you try and get that formula? So there's a calculation. The fixed costs were given to you right at the bottom 861,300. You were given the selling price and you were given the variable cost per unit. If we look back over here, there's your total fixed cost, 861,300. Or, if you didn't see that, you could have taken your unit costs for your fixed cost per unit, 29 Rand 70, times the 29,000 units. It would have given you the same thing. And you divide it by the contribution. Now the contribution is the extra bit after paying the variable cost. So your selling price of 97 Rand minus your variable cost of 56 Rand 50, which gave me then a contribution, in this particular case, of 40 Rand 50. So those 40 Rand 50s are going then to pay the 861,300. And please, when we work it out, we don't sell a part of a unit. So unlike any other accounting rule or what you would have learned in maths before, we always round up, even if it's comma 1, comma 2, we round up, because we're going to have to, we can't sell comma 1 of a unit. And so my break even is 21,267. And then in order to comment on this, and this is very typical, is to comment on the break even point and the level of production. Remember, your break even is the point at which you will be covering all your costs. Anything over that, if your production is more than that, every one of those will be bringing you profit. And so what you're aiming for is to get your level of production as high as possible compared to the break-even point. And so in any comment on this thing, you first of all need to comment on the break-even point from last year to this year. So last year we were at 18,578 already, we were making a profit. This year we have to make 21,000, so that's not good, because we're going to have to make more units before we can start making a profit. So that's the first point. You need to compare that to that. Secondly, your production. Last year you were making 40,000 units, and this year you are making 29,000 units. So again, not good. You are making less units than you were last year. And take note that it's not just commenting on the break-even, because they've asked you to comment on the level of production. And then to finalize this whole thing, just last year you were making 40,000 and you had a break-even of 18,000. The difference between that is much larger than between 29,000 and the 21,000 odd that we had for the break-even. So in other words, you actually are decreasing this year. You're making less profits this year than you were last year, and that the management are not going to be happy with. So any comment, compare from last year to this year, the break-even point. Second bullet point, compare the production from last year to this year. And then thirdly, compare the break-even to the production of each one of those years. Right, I hope that has helped you with break-even. Break-even is a very important concept for you to cover in exams, and you need to know that you can understand it. And that is relevant to both grade 11s and grade 12s.